Hello, everyone. This is part four of my video series on the state of the economy and what we can expect next. This is sort of a cleanup and an expanding on part three that I just posted. First, a couple of slips of the tongue that I made in the part three video when I was talking about inverted yield curves, and I said a common um, yield spread that people look at were 2-year bonds versus 30-year bonds. No, the most common you hear about is 2-year versus 10-year. Sorry. Um, Although it's interesting to watch the 30-year rate as well. Another slip of the tongue. I mentioned it's easy to confuse the rate on treasury bonds that are being bought and sold in the market versus the federal funds rate, the rate that the Federal Reserve Bank charges member banks to borrow cash. I did that yesterday when I said something like the bonds are selling at what, like 4.74%. No, that's the Fed funds rate is about 4.75%, not bond rates. In fact, let me go into some of the details more specifically that I didn't cover yesterday about this inverted yield curve. Now we're talking about US Treasury bond rates. This is as of this morning, as of Tuesday, April 4th, according to my Mickey Mouse Watch. A 2-year Treasury bond this morning is giving an interest rate of 3.88%. Notice the federal funds rate is 4.75. Gee, it really would be nice for banks if you could borrow money from the Fed at a lower rate than the interest rate you were making if you bought a treasury bond, wouldn't it? You'd borrow some money, invest it in treasury bonds, and make money on the borrowed money. Well, that's not the case. It's for a long time, the Fed funds rate was like 1/4%, was close to zero, which is why we had so much easy money for 10 years. And then that plus a huge expansion in the money supply when COVID hit is what gave us inflation to a large degree. But anyhow, the 2-year Treasury bond is yielding 3.88%. The 5-year is yielding 3.45% under the 2-year. So you're getting less interest for a 5-year bond than you get for a 2-year bond. This is inversion. The 10-year, 3.39% is lower than the 5-year. Now I mentioned the 30-year is higher than the 10-year. It's 3.62%. So you are getting a little better interest rate on a 30-year than you are on a 10-year or a 5-year, but note, it's still a lower interest rate than on a 2-year bill or a note. I forget, anyhow, I'll just call them bonds. So the 2-year is paying a higher rate than the 5s, the 10s, or the 30-year maturities. Now, I mentioned yesterday that the Fed sells bills with durations as low as 4 weeks and 8 weeks. Here's how much strain there is in financial markets. Now, you would expect the interest rate is not going to be great on a bill that expires in 4 weeks, right? Certainly a 2-year should be a higher yield than a 4-week. Well, yes, it is. You would expect to get some interest for lending the government your money for 4 weeks, right? Well, at recent auctions, just in the last week or two, we had some 4-week bills, treasury bills, were sold with an interest rate of 0. No interest at all. People were willing to, well, institutions were willing to give the Federal Reserve, money, 10,000, 50,000, $100,000, various amounts, and get nothing for it except the promise that they would get their money back in four weeks from now, exactly what they had put in. Why would institutions do that? Why would you give the Treasury money at zero interest? Well, because as I mentioned yesterday, Treasury bonds in general, whatever duration, are effectively money that large institutions use. They trade with each other, they lend to each other, they buy, sell, lend, swap. It's easier if you've got a multi-million-dollar project that you want to invest in. You want to send a truckload of $100 bills, adding up to $5 million over to this other company. No, nobody does that. Nobody does that. But you could send a bunch of $50,000 Treasury bonds. They're like cash, but better because they're not nearly as bulky as $100 bills. And it's cash with interest. It's cash that's guaranteed to pay you some kind of interest. Maybe not a lot, but it is paying interest while you hold it. So this is a major means of international and interinstitutional transactions within the U.S., outside the U.S., all around the world. Treasury bills, notes, and bonds are used as a form of loans and payments. So it indicates there was a severe need for a cash equivalent. Financial institutions were feeling the squeeze. They were feeling a need to have more capital on hand, even if it was paying zero. And this is what the Federal Reserve wanted. We talked about the enormous increase in the money supply when the government started sending out stimulus checks, holding off on mortgage delinquencies, holding off on student debt payments, all kinds of programs, a dozen or so programs trying to ensure that the economy didn't die when we tried to shut down as much as we could for COVID. So that 2020, 2021, enormous increase in the money supply. This did have a good deal to do with inflation suddenly rearing its ugly head. Now the Federal Reserve is trying to drain money out of the financial system, reverse some of that enormous increase in the money supply that they realize triggered inflation. Well, they're succeeded with their raising of interest rates, slowing loan processes because interest is higher. Quantitative tightening is called, which is a method of withdrawing money from the economy, and general anxiety about where the economy is headed next, and banks having a problem with people withdrawing money from the bank. So there's a sudden scramble to have more collateral, more very liquid collateral, very liquid collateral for financial institutions means very short duration Treasury bills, 4 week and 8 week. You can always sell them in the financial markets. So they were being sold by the government was finding buyers at 0% interest. This is another indication of very significant strain in the financial system. And the significant strain is caused by how rapidly interest rates went up. We've never seen interest rates go from near zero to 4.5% or higher in a year. Never. So this caused extreme strain, especially on banks and other financial institutions. Why do you think it is that Silicon Valley Bank suddenly collapsed? That what was it named? Silvergate Bank folded. That Signature Bank was taken over. That Credit Suisse, one of the 30 largest banks in the world, suddenly overnight it disappeared. The Swiss government forced a shotgun marriage in which United Bank of Switzerland, UBS, bought out Credit Suisse. It overnight, one of the 30 largest banks in the world, gone. Okay, why this strain in the banking world? Well, a lot of banks, Silicon Valley Bank was a severe example. When interest rates were below 1%, Silicon Valley Bank took deposits that Silicon Valley institutions were giving it. It was a major financer of the high-tech industry. So its clients were not run-of-the-mill retail customers. Its clients were venture capital funds, hedge funds, new corporations trying to get their business going, high net worth individuals and institutions were depositing their money in Silicon Valley Bank. Silicon Valley Bank took that money and they bought quite a bit of long duration treasury bonds at very low interest rates. Then the federal government, the Federal Reserve, starts hiking up interest rates. And so the interest rates on treasury bonds start to go up too. Okay, they didn't go up as high as the Federal Reserve, but I just mentioned the 10-year right now is selling for 3.39%. They're holding 10-year bonds that had a interest rate of 1.2%, let's say. But now you could go buy a new one for 3.39%. If they need to sell their 10-year, how much do you think they're going to get for it? Let's think of it like this. If you put $1,000 into a bond that's has an interest rate of 2%, and then in the course of a year, the interest rate on new bonds has gone up to 4%. Now you want to sell your 2% bond. So it's $1,000 bond. What will someone offer you for it? Maybe $500. See, if they buy it for half its face value, now the effective interest rate jumped from 2% up to 4%. So when the interest rates on new bonds go up and you want to sell your old bond that has a lower interest rate, you're going to have to take a loss on the face value of that bond so that its effective interest rate comes up to what the current interest rate is. So banks around the world are holding what they call unrealized losses on their bond portfolios of bonds that they bought a year or more ago at much lower rates, because if they have to sell them, they're going to sell them at a loss. Now, they don't have to declare the loss as long as they hold them. And many of these bonds were marked as hold to maturity, that we don't plan to sell them. Or they didn't plan to sell them. But if they get a rush of depositors asking for their money back, they may be forced to sell them at a loss. Now, the unrealized loss, the book value loss that wasn't realized, suddenly becomes realized when they're forced to sell. This is what was happening to Silicon Valley Bank. Why a rush of withdrawals? Well, you have, think about you probably have a savings account, you have a checking account, pays some kind of interest. What kind of interest are you getting? Nothing. Effectively, I on my checking account, I'm still getting a negligible interest. I mean, way less than 1%. I can withdraw that money from my checking account or my savings account at the bank. I can go invest it in a money market fund now and get a much higher rate. I can go and buy a treasury bill at a much higher rate. Let me tell you about something I didn't talk about for individual investors. This is something I did last year, late last year. There is a bond that's a U.S. Treasury bond that's specifically designed for retail, that is individual investors, not for banks or large corporations. In fact, the maximum money you can put into these in one calendar year is $20,000. You cannot buy more than $25,000 worth of this in a year, but every year you could put up to $20,000. You don't have to invest that much, but that's the maximum. You can invest it in one lump sum, or you could buy in multiple small portions in the course of the calendar year, as long as you don't exceed 20,000. Won't let you. They're called I bonds. The I bond rate, if you go to US Gov today, you can just Google I bonds and you'll find it. You can go there, establish your account, you can buy an I bond. What's the rate you'll get? 6.89%. That's higher than our current inflation rate. You're actually making money despite inflation. What about those other bonds? We just said the 2 years at 3.88%, the 5 years 3.45%, the 10 years 3.39%, the 30 years 3.62%. But you buy an I bond as an individual, you get 6.89%. Now, if you really want to chase yield and you're willing to take risk, because now here you are taking risk. Some of the high yield corporate bonds are paying as much as 12% annually. Gee, that sounds great, 12%. Well, yeah, but that interest rate is high for a reason, because the company is considered risky. As long as the company survives and is able to keep making its debt payments, yes, you'll be collecting 12% per year. But there's always the possibility that the company might go bankrupt, or that its stock value might be cut in half in the next 12 months. And then if for some reason you decide that you need to sell the stock, well, the losses that you take on the value of the stock that you purchase will more than wipe out any of the dividends that you were earning for the dividend payments, or if you're forced to sell your high yield corporate bond, again, depending on where interest rates go, you might take a loss on the face value of the bond. But the so-called junk bonds, some of them are yielding up to 12%. Some of the high dividend stocks are paying the 6% or more. Again, I was starting to conflate dividend payment, high dividends on stocks, and high yield corporate bonds. They're both issued by companies, but stocks and bonds are different entities. Anyhow, interest rates, you can get as high as 12% on lower grade corporate bonds, but you can't find anything that's going to be safer than an I bond. The U.S. government is never going to formally default on its bonds, or if it did default, it wouldn't be for very long. We would have to make it up. So the 6.89%, looking for that, make sure I got that figure right again. Lost my place on it. Yes, 6.89% today. Now there are some caveats on this. They're 30-year bonds. That is, after 30 years, you get your principal back as well as all the interest that was coming along the way. But you don't have to hold them for 30 years. You must hold them for a minimum of 12 months. So if you want to buy if you're thinking about buying an I bond like I'm talking about, you've got to know that you're not going to need that money back in the next 12 months. As long as if you hold it for 12 months or longer, after that, you can redeem the bond. You can sell it back to the government, get everything you put into it. So you bought $1,000 worth. You get your $1,000 worth back. Plus, you will get that 6.89% interest for all but the last 3 months when you're redeeming it before 30 years. When you redeem it, you don't get the interest for your final 3 months. Well, I was thinking to myself, well, if I hold that for at least 2 years, that sounds pretty good to me. I hold it for 2 years, I get 6.89% for 21 out of those 24 months. And just the last 3 months, 0 interest. Overall, that's still, I think, a better interest rate than I would get on a CD or a money market fund or other relatively other safe investments. This is one of the best guaranteed investment rates that you could get right now as an individual, as long as you're willing to tie your money up for a while, a year, 2 years. I think 2 years would be I felt was a nice target. So banks are under stress because customers have been withdrawing their money, because customers are finally waking up to the fact that, geez, I got a bunch of money sitting in a bank, it's earning nothing. But look, bonds are suddenly paying 3-4%. Corporate bonds are paying higher than that. I bonds are paying 6.89%. Money market funds are paying way more than they were. Why am I leaving my money in the bank? So since last September, when interest rate really started to kick in, $750 billion have left U.S. banks and went other places. They went to money market funds. They went to CDs. They went to mutual funds that hold treasury bills. They went to anything that's paying higher rates than the nothing that banks are still giving you. People are finally waking up, and the high net worth individuals are the first ones to move their money when they see a better opportunity. The average of the retail, that is individual and families that have checking accounts in banks, they're not so inclined to move their money. They don't have their money in a bank to make money. They have their money in the bank so that if they need some cash for the week, they can go to the ATM and they can withdraw the cash. Or they can go to the teller and cash a check. Or they can buy a bank check or something. They use it for the convenience. That's why. Or they get a credit card from the bank, things like that. So they're not so inclined to move their money. Plus, they know that if your investment is less than $250,000 now in the bank, you're fully covered. You're buying federal insurance. So they're not inclined to move. But these corporations, venture capitalists, people like that, if they put $1 million into a bank, and now they see that, they could, why don't I just put that money in a money market fund and earn, I'm not sure what, the 3-4% instead of the nothing burger that I'm getting from the bank. They're withdrawing their money, they're putting it elsewhere. A lot of it went into money, as I say, into money market funds. So $750 billion left US banks since last September. That really accelerated after the collapse of Silicon Valley Bank. Now, it's true that the large banks had more withdrawals than the smaller banks, but as a percentage of their net worth, the smaller banks are losing money much more rapidly than the large banks. I really wouldn't worry about our big banks. I'm talking about, you know, J.P. Morgan Chase, Citibank, Bank of America, Goldman Sachs, which now is a bank, didn't used to be. These four big banks, don't expect them to go under. The Federal Reserve will do whatever it takes to make sure that our largest banks do not fail. They won't fail. Smaller and mid-sized banks, oh yeah, I expect we will see some more failures, takeovers, forced mergers, whatever. Their capitalization, their net worth is not anywhere near the size of these big banks. And if there's a run on the bank, if suddenly, as soon as people start to feel insecure, is this bank really safe? They all rush to take their deposits out. And as soon as they do that, as in Silicon Valley Bank, as in Credit Suisse, well, overnight, the bank can have more requests for withdrawals than they have cash on hand or can raise. This is why the Federal Reserve suddenly created a new window. They said they had all the tools they needed. Suddenly they realized, oh, we need a new tool, because all the banks are holding these old treasuries that aren't worth as much as what they paid for them if they have to sell them. Geez, we could have a lot of bank failures if there's withdrawals and they don't have the cash to cover it and they're forced to sell these bonds at a loss. Okay, we're going to open a new window. Any bank in our system can bring their old, their tired, their poor, beaten down treasury bonds and some other financial instruments, turn them in at this new window. We will give them 100% the face value in cash. Although in the open market, it might take a severe drubbing, severe loss on selling it. We'll give them 100%. We can hold it to maturity if we have to. We'll hold it forever. We don't have to take a loss on it. Or if rates come down some years in the future, we'll sell it then back at face value. We don't want to see more runs on the banks. So anyhow, not only were banks underwater on all the treasuries from a year or longer ago that they were holding, they're no longer worth their face value because interest rates went up. Hope you followed that argument. Here's another shocking fact. This was just reported this morning. About 40% of the companies that are listed in the Standard & Poor's 500 stock index, 40% of these companies have a negative net worth. If they had to liquidate today, if they had to sell their assets, their assets would not cover their liabilities. Technically, they are bankrupt. 40% of the S&P 500. These are some of the indicators of how much strain there is in our system right now, a great deal of which is due to a very rapid rise in interest rates, and nobody was ready for it. The rapidity of change in economic conditions often triggers way more instability than the overall size of the change. If you spread out an increase of 4 4.5% in Fed funds rates, for example. If you'd spread that out over 5 years, it would have been way more easier for banks to deal with that than when it's compacted into about a year or so. And suddenly they find themselves underwater on what they were holding. So I think I've covered about everything I wanted to cover today. I'll probably think of something else as soon as I quit. But in summary, we see this unfortunate environment of the economy is slowing already. By the way, recessions don't, sometimes they never even get declared until after the fact, because the institutions that declare that there was a recession, they wait until the data comes in, quarterly data, and after they have a couple of quarters of clearly shrinking economy, then they say, oh, we've been in a recession. If it's a short recession, by the time they declare it, it was already over. I don't think this recession is not going to be a short recession. It may drag on. We could already be in it right now as we speak. It's kind of hard to say. Yes, I know unemployment rates are still low, but they're beginning to pick up. This one could be more lengthy and stronger than, as I mentioned yesterday, any that we've seen in a long time. What about the stock market? Some pundits that I respect their opinions. They're not just shills. They have pretty good understanding of the financial system. Some of them are saying we may not see another stock market high for a decade or longer. When you have a bad recession, like the 2001 the collapse of the dot-com boom, for example, or first in the 1930s depression, it can take a decade or more before stock valuations get back to their prior peak. We could easily see that again, where the last market highs we've seen, we don't get back there for another 10 years or longer. This could happen. Absolutely, it could happen. Oh, right. The last thing I want to talk about is some other good sources of information. The first one, I may have mentioned it in some prior video in the past, but I'm mentioning it again because I think it's hard to find a better rundown of how the global economy actually works nowadays, and for the past 100 years or so. It's called Money as Debt. Money as Debt. You can find it on YouTube. That was very popular. Then there was a second one released, strangely enough, called Money as Debt 2. But I really recommend the first one very highly, Money as Debt. You can watch it as a one-part video that's maybe an hour and a half, or you can watch it in 3 sections, about a half hour each, as I recall. That is the best hour and a half I ever spent in terms of my understanding of how the world economy works. Money as Debt on YouTube. 2 other commentators that are very knowledgeable. Mohammed El-Erian, you can find many videos from him on YouTube. Mohammed, that's the way he spells his name. L-E-L, Arian, E-R-I-A-N. Mohammed El-Erian. Excellent commentator. A second one tends to be more on the gloomy side, but very, very smart. Nouriel Roubini. fascinating. I love his name too. Nouriel Roubini, Roubini. By the way, he is so multicultural in his background. It would really be very hard to find a person with a more diverse background, with a better, broader understanding of the global economy than Nouriel Roubini. Plus, he's extremely smart. he's way smarter than I am. He's smart. He's way up there in terms of his intellect. There was an excellent PBS series came out, I don't know, a month or so ago. I think you can watch that on YouTube. The Age of Easy Money. Of course, what we have now is, this is why we're under strain. The age of easy money is over. Over. Even if the Fed does have to lower interest rates, we'll never again in our lifetime see as rapid as an expansion in the U.S. money supply as we saw in 2020, 2021, which was a big, big mistake. So the age of easy money talks about why it happened, how it happened, and the consequences. Great PBS production. That's it for today. So I've made at least a couple of suggestions about what you may or may not do with your money. I don't. It's hazardous to give financial advice, so just take it as my personal opinions. Not that I'm telling you to do this. I'm telling you what I've done, and you may or may not find it that it works for you. I might be totally mistaken. A couple of times in the past, I found that I was wrong. So I want to say I'm giving you financial advice. I'm giving you my opinions based on based on my research. That's all. Hope you enjoyed it. Again, give me feedback and comments if you have something to say. Give me a thumbs up on YouTube, subscribe, all those nice things. If you don't like it, don't say anything.